Hi, I wanted to give you an explanation of essential question number one that was given on November 7th in the fall of 2011. What we have here is that you have a magazine which showcases local artists and musicians, and the first thing that you're going to do is take out a loan to have some extra cash on hand. So what you're doing here is you're getting some extra cash. Those are some assets. And at the same time, you're getting some liabilities. Remember, your balance sheet has to balance, so the sum of liabilities and under equity should equal the assets. At the same time, you're taking out a loan, and one of the items is cash. That means there's going to be a kind of an echo that's there on the finance side, and you'll see an increase in cash, and the source of that is supposed to be finance. So that should be number one all ticked off for you. Question number two, which we'll go ahead and do in red. An old friend approaches you becoming a partner of the business for $40,000. You accept his offer. So what happens here is your business suddenly has $40,000 more cash, and to balance it off, it has $40,000 more equity. Now, what's fun about this is that changes in owner equity usually end up being reflected over on the cash flow statement in the finance section. So you've got finance again as being a source of cash. That's question number two. Question number three, we'll go ahead and handle that one in yellow. You pay for radio advertisements with a credit card, company credit card, to promote an upcoming event. So right there, what we have is an expense. So we have an increase in operating expenses. That makes net income go down. And anytime you've got a change in net income, it causes a change over in cash flow. Cash from operations. So there's going to be this decrease in cash from operations. And that should be 3, giving you a reasonable answer. Let's switch over to blue for the next one, which is going to be 4. You had 3 new part-time journalists and 1 photographer for the staff. Well, that's a bunch of expenses. And that makes net income go down, and that makes cash from operations go down. Hey, that's the same as the previous question. Man, that makes it easier. So let's go ahead and get a new color, green, for make a payment on the loan. And we're gonna divide this up because sometimes loan payments get a little bit weird. First, you know that you're going to have some assets go down. You're paying cash. Then the amount that you owe is also going down. They should kind of balance each other out. And at the same time, your cash from finance is going down. Now here's the deal. Some of you will also think that there's an interest expense and things like that. So things get like a little extra complicated because you have this increase in expenses over here, decrease in net income, and I'd rather you not play with that. As long as you get this relationship down correctly on the balance sheet and the cash flow statement, I'm pretty good about it. Next question, let's go ahead and I'll give you an orange one there. Raise your subscription prices, and we'll assume that none of your customers leave. You actually end up with more revenue. When you end up with more revenue, your net income goes up. And when your net income goes up, your cash from operations goes up. So that's kind of an easy one for you. Oh no, upset customers cancel subscriptions due to raising prices. Actually, this one could actually go either way. So let me pick a new color for that. I'll pick yellow. And this one could actually go either way, depending upon what the result of the other one was. I think what the intent is to make it so that revenue goes down. So we'll make net income go down and cash from operations goes down. So we'll do that. And the last question, we'll head back to black for this one. Buy some new computers and a TV for the office. Well, this is just a straight up exchanging current assets for fixed assets. So cash goes away. You get your TV of equal value that's there, and you have a decrease in cash from investments. That's how those long-term asset purchases look like when you do them for cash. So this is a explanation for essential question given on November 7th in fall of 2011. Thank you.